Imagine waking up in 2026, checking your portfolio and realizing $8 trillion just evaporated from global markets. Headlines screaming dollar dead, depression 2.0, great reset, and your YouTube feed looks like the financial version of a horror movie trailer. Here's the awkward question. Is this just the algorithm farming your anxiety? Or are there actually enough real warning signs clustering around 2026 that smart investors should quietly be paying attention? Today on the comments section with Thomas Paul, we're connecting the dots on all these 2026 recession and collapse warnings. What's hype, what's actually credible, and how to build a game plan so you're not panic selling at the bottom or YOLOing at the top. Quick disclaimer before we melt any brains, nothing here is financial advice. This is education and entertainment. You're responsible for your own decisions. Talk to a professional if you need one, and definitely don't base your retirement on a guy from the internet explaining macro with memes. All right, let's start with the obvious. Why is everyone suddenly obsessed with the year 2026? This didn't come out of nowhere. There are four big forces all kind of circling the same time window. First, government debt and interest costs. The US has stacked up a mountain of debt, and for a decade it was basically free to carry because rates were near zero. Now, rates jumped, and a growing chunk of tax revenue is just interest. As more old, cheap debt rolls off and gets refinanced at higher yields, those interest costs climb. That doesn't have to trigger an immediate crisis, but it makes the system more fragile. Markets start asking, how long can you keep this up without cutting something, raising taxes, or letting inflation run hotter? Second, the higher for longer rate narrative. The Fed hiked hard to fight inflation. Markets want the old world back. Zero rates, everything bubble, stonks only go up. But the new regime looks more like rates a bit higher, for longer than people are comfortable with. Even if the Fed cuts, we might not go back to 2020 levels. That's a huge deal when you've built an entire financial system on cheap money. Third, corporate refinancing walls. A ton of company debt, especially stuff issued when money was basically free, comes due over the next couple of years. They either pay it off or they roll it at whatever rates exist in that moment. 2025 to 2027 is a big cluster of that. If rates are still elevated, suddenly your fine balance sheet becomes, why is half our cash flow going to bondholders? Fourth, late cycle consumer stress. People survived the inflation spike with stimulus savings, cheap credit, and rising home values. A lot of that cushion is gone. You're seeing record credit card balances, more buy now, pay later, rising delinquencies on some loans, and quiet layoffs. The average household is more sensitive to job loss or higher interest costs than they were 3 years ago. Put those together, and 2026 shows up as a likely window where this stuff collides. Government, corporations, and consumers all dealing with higher costs in a slower economy. Notice the word I'm using, window, not apocalypse timestamp. I'm not selling you a calendar date for the end of capitalism. The 2026 idea is more regime shift than extinction event. Think, a change in how markets price risk, what valuations people will pay, which assets work, how leverage behaves. So the goal here is not prediction, it's preparation. You don't need to know the exact month something breaks. You need to understand the plumbing well enough that you're not shocked if it does. And here's where it gets interesting. Because YouTube heard the word plumbing and said, cool, but what if we called it an 8 trillion nosedive instead? Let's talk about the viral collapse warnings. You've seen the thumbnails, burning dollars, red arrows. They're hiding this from you. Some guy looking shocked into the camera. The pattern is pretty consistent. They take real issues, commercial real estate stress, BRICS headlines, US debt, deglobalization, and then jump straight to engineered dollar collapse, banking system meltdown. This time it's 100 times worse than 2008. Now, are any of those ingredients fake? No. Commercial real estate, especially offices, is absolutely under pressure. BRICS countries are absolutely annoyed with dollar dominance and experimenting with alternatives. Debt levels are absolutely high. Those are real. The problem is the leap from real risk to inevitable, world-ending scripted collapse in exactly 2026. Click here to survive. Creators bundle legitimate concerns with extreme conclusions because fear sells. And fear with a date sells even better. On the other end of the spectrum, you've got more sober recession warning content, same macro themes, slower growth, consumer pressure, tighter credit, lagged impact of higher rates, but with words like probability, scenario, cycle, drawdown risk. Less Hollywood, more actuarial table. My philosophy lands much closer to that side. Don't speak in prophecy, speak in probabilities and mechanisms. I don't care if someone says the dollar is dead. I care if they can walk me through, clearly, how stress in one part of the system transmits to another. Here's a quick BS detection checklist you can use on any 2026 crash video. If they can't explain the actual mechanism, the plumbing, in under 2 minutes, treat the title as entertainment, not a forecast. So if you hear, "BRICS will kill the dollar," the mechanism should sound like lower demand for treasuries, higher funding costs, tighter global financial conditions, knock-on effects for risk assets. If they jump straight from BRICS meeting to your savings will be gone, that's vibes, not analysis. Same with 8 trillion commercial real estate time bomb. Okay, what's the channel? CRE defaults hurt banks' balance sheets. That can reduce lending, raise funding costs, and tighten credit. That's an actual path to broader stress. If they can't walk that line, they're selling you a movie trailer. But let's not pretend there are no real risks. There absolutely are. So let's zoom in on what could realistically converge into a 2026 recession or a sharp market drawdown. Number 1, elevated policy rates that stay higher, longer than markets have priced in. Markets are always front-running cuts. If inflation is stickier or growth doesn't fall off a cliff fast enough, the Fed can hold rates up or cut slower than stock investors want. That means higher discount rates on earnings, which pushes down the fair value of high-growth, long-duration stocks. More pressure on leveraged players, private equity, overextended real estate investors, zombie companies that only survived on cheap debt. Number 2, rolling refinancing at higher yields. Every time a treasury matures and gets rolled at a higher rate, government interest costs rise. Same for corporate bonds and loans. The refi wall is like a slow-moving squeeze on margins. Strong companies can eat it. Marginal ones can't. If enough marginal borrowers hit the wall around the same time, you get defaults, layoffs, cost-cutting, and a broader hit to confidence. That's a very normal recession dynamic. It's not mystical, it's math. Number 3, consumer balance sheet fatigue. Wages have risen, but prices rose too. The cost of housing, insurance, healthcare, and food didn't politely go back to 2019. Households plugged the gap with savings and credit. As delinquencies tick up and savings down, consumers pull back. That hits earnings. Earnings weakness plus high rates is the classic recipe for a repricing in stocks. Number 4, fragility in specific asset classes. Commercial real estate, especially office, is the obvious one. Rising vacancies, falling valuations, loans that don't refi cleanly. Parts of housing are also weird. Structurally short supply, but affordability absolutely wrecked. Add in speculative pockets, unprofitable tech, meme-ish names that only work when liquidity is free. Those areas can crack even if the broader economy is okay-ish. All of that is consistent with a late cycle, higher volatility environment. You don't need a hyperinflation collapse narrative. You just need enough pressure points breaking at once. So, that's the diagnosis. Let's talk prescription. How do you actually position for 2025 to 2026 without switching between FOMO and bunker mode every week? Rule 1. Respect the risk-free rate. When T-bills and high-quality bonds are paying a decent yield, your bar for owning risk assets needs to go up. If you can get, say, 4 to 5% on basically risk-free paper, why are you buying a stock with a 3% earnings yield and shaky growth? Demand a real earnings yield above the risk-free rate. If a stock's earnings yield minus inflation minus the safe rate is negative, you are paying a premium for a story. Rule 2. Avoid concentration in easy money story stocks. The last decade rewarded anything tied to low rates, hyper-growth tech, profit-optional business models, meme names with no real cash flow. In a higher rate regime, the market starts asking rude questions like, do you make money? A portfolio built on vibes and TAM slides is going to be brutalized in a tightening, choppy world. That doesn't mean no tech or no growth. It means you need actual business quality, real margins, real cash generation, balance sheets that don't implode if refinancing costs double. Rule 3. Keep a real cash buffer and staggered fixed income exposure. Cash is optionality. In stressed markets, liquidity disappears exactly when you want it most. A cash buffer keeps you from being a forced seller and lets you buy when valuations reset. On the bond side, think in ladders or staggered maturities so you're not all in on one rate outcome. If yields spike, maturing bonds can be rolled at higher rates. If yields fall, your longer duration pieces benefit. Rule 4. Be intentional with crisis hedges, gold, crypto, tail risk trades. These are tools, not religions. Gold can work as a hedge against real rate suppression or loss of confidence. Crypto has different lanes, Bitcoin as a macro asset, Ethereum and others as infrastructure bets, versus casino coins that are basically leverage on human stupidity. Tail hedges, like FAR OTM puts, bleed money most of the time and then pay off rarely. Decide what you're actually hedging. Inflation? Currency risk? Equity crash? Then size those bets so they don't blow up your plan if they're early or wrong. Underlying all of this is one theme: process over prediction. You build a rules-based framework that's robust across different scenarios, and then you tweak around the edges as data comes in. You don't toss your whole strategy every time a new 2026 crash-confirmed thumbnail hits your feed. Speaking of data, let's build you a simple dashboard so you're watching actual signals, not just headlines. Over the next 12 to 24 months, there are a few things worth tracking. First, unemployment versus inflation. If unemployment stays low and inflation moderate, the Fed has room to be patient. If unemployment starts rising sharply while inflation is still sticky, that's the nightmare combo. Policy gets trapped. Rising jobless claims plus stubborn inflation is a huge red flag for recession risk. Second, credit spreads. Not just the level of rates, but the gap between safe bonds and risky bonds. When that spread blows out, markets are saying, we suddenly care a lot more about default risk. Widening spreads are the sound of the refi wall cracking. Third, delinquency rates. Credit cards, auto loans, maybe even some mortgage segments. Rising delinquencies show you where the consumer is breaking before it shows up in the big GDP numbers. If you see delinquencies, spreads, and layoffs all moving the wrong way at once, that's when you start shifting from volatility to real recession risk. Fourth, commercial real estate headlines and data. Are we talking one-off distressed towers or system-wide pressure on banks and lenders? Watch for phrases like loan extensions, amend and pretend, and regional bank exposure. If a cluster of regional banks starts wobbling over CRE again, that's a sign the stress is more than just offices. Fifth, the path of Fed rhetoric versus market expectations. Markets are constantly pricing in where they think rates will be. The Fed is constantly hinting where they think rates should be. When those two diverge massively, someone is very wrong. If markets are pricing aggressive cuts and the Fed keeps saying higher for longer, that's a setup for volatility when reality hits. Here's how to use this. If X, Y, and Z are all breaking at the same time, rising unemployment, widening credit spreads, rising delinquencies, ugly CRE headlines, and a Fed that can't cut as fast as markets want, then 2026 stops being just a YouTube storyline and starts being a real portfolio risk window. You don't need to panic if one light is yellow. You start getting serious when several are flashing red together. Let's land this. Recessions and drawdowns are not bugs. They're features of a credit-based system. We've had them over and over again, and every time, the headlines make it sound like the end of the world. Markets fall, people who were over-leveraged and underprepared get wrecked, assets change hands, and then the world keeps going. The danger for you is not recession exists. The danger is being overexposed, overconfident, and underprepared when the music stops. So if we strip away the cinematic thumbnails, what's left? Separate narrative from mechanics. Don't get hypnotized by words like collapse and reset if no one can explain the transmission mechanism. Ask, what breaks, in what order, and why? Build a rules-based plan. Demand a fair return over the risk-free rate. Avoid concentration in stuff that only works in zero-rate fantasy land. Keep a cash buffer and diversified fixed income. Use hedges deliberately, not emotionally. Watch a short list of indicators, not every headline. Unemployment versus inflation, credit spreads, delinquencies, CRE stress, Fed versus market expectations. That's your actual 2026 dashboard, not whatever the algorithm thinks you'll rage click. And remember, the flip side of drawdowns is opportunity. If we do get a serious reset around 2026, that might not be the end of markets. It might be the best buying window you'll see in your entire life, if you have dry powder, a plan, and a pulse. This is the comment section with Thomas Paul. Drop your take in the comments. Are you treating 2026 as a nothing burger, a genuine risk, or the opportunity of the decade? And if you want more straight talk, no screaming thumbnail coverage of this stuff, hit subscribe so you don't have to navigate this circus alone.